In brief, this chart just shows you the commodities index, the Goldman Sachs Commodities Index versus the S&P over a long period of time, 50 years. And you can see that we are coming off the back of a long period of underperformance. You can see from the peaks of the GFC of 2008, we've now been through a very long period of underperformance versus the broader market. We think we're just at the start of what could be a very long and sustained outperforming period. And I'll take you through that in a moment as to why. But one of the biggest tailwinds at our back is going to be this decarbonisation or electrification theme. Some of these stats will be familiar to you. The chart on the right just shows you what's going to drive, as components of demand, the demand for some of these commodities. No secret that obviously EVs are a big component of that, but also renewable power is clearly a big component, as well as the build out of the energy grid. But in terms of some simple numbers, the bottom left there just shows you that the average EV consumes 6 times as much of the battery metals that you would see in your standard internal combustion engine vehicle. Combine that with the fact that we're going to see 8 times as many EVs on the road. Even I can do 6 times 8 to work out what that's going to mean for the demand for battery metals. If there's one slide I want you to take away from today, it's this one. There's an awful lot going on, but in simple terms, it draws some analysis from Benchmark, who Stuart referred to earlier. It just shows you, on average, how many new mines we're going to need between now and 2035 in each of these various commodities. Now, to use graphite as Stuart's example, we're going to need over 100 new mines between now and 2035. We've got some challenges, not least of which is the permitting perspective, the funding perspective, but also the fact that in terms of the number of Western listed graphite producers on this planet who've got a mine in operation, how many others, Stuart? One. So that gives you an idea of what challenges we face with regards to the amount of new supply we need, whereas what we're all focused on has been demand. Supply is the factor that no one is really thinking about. Part of the challenge is this. If I draw your eye to the right-hand side of this slide, now this just shows you a selection of enabling commodities and where they're processed. All of you can see the big chunk of where they're processed and one of the biggest challenges we face. This is why the US have just passed the Inflation Reduction Act. It's why the EU are rapidly scrambling to write their own. It's why Canada are writing their own, because no one wants to be as heavily exposed to China going forward. Now, Chinese processing, there are a number of different factors behind that. Of course, in the past, China urbanisation was a huge driver of demand, and so they needed a lot of their own commodities. It doesn't take a genius to work out that they're not Robinson Crusoe. They know that there's a strategic angle to this, and they know that everyone else will be scrambling as well. This is why everyone else is scrambling to draw their own supply to their own countries. They don't want to be reliant, and all of that is inflationary. Commodity prices have to go up to justify new supply. I've talked about demand and supply, but what we're not focusing on is the fact that we have very little fat in the system. Top left just shows you copper over the last 5 years, and you can see there's a very clear seasonality to inventories, but there's also a very clear trend downwards. We're now sitting at just about all-time lows of copper inventories at a time when, to the top right, demand is going up. I won't say exponentially, but it may as well be in terms of the impact on price. The point being, we're going to need something like 8 million tonnes more copper between now and the end of the year. That doesn't make any sense if you don't have any idea what the size of the market is. But the reality is, we're going to need the world's biggest copper mine, Escondida, which produces about 1 million tonnes a year, every single year, a new one between now and 2030. Replacement cost of Escondida, about $25 billion. How many new copper mines of that scale do you know of being built today, or even thought about being built today? The answer is none. There are no new copper mines of that size being built today. And why? Because we've talked about the permitting side, and it's very difficult to permit. But the reality is the capital markets, all of us in this room, all of us who invest in mining companies, and indeed many who don't, have been beating these guys around the years, telling them they're shit allocators of capital. Fair criticism in many cases. But the reality is we've been telling them, don't put your money in the ground. Pay down your debt, buy back your stock, pay us a dividend. Whatever you do, don't put it in the ground. We penalise companies who have board members who've been on the board for longer than 5 or 10 years. The average time frame from first successful drill hole to first production used to be 7 to 10 years. That 7 to 10 is now 15 to 20 years. So at a time when it's never been more difficult to permit a new mine, at a time when it's never been more difficult to fund a new mine, we've got the mother of all challenges to meet that supply challenge. What does that mean? Prices going up. This is the other factor that's driving a big challenge in terms of building new mines. On the left-hand side, you can see cost curves. So the cost it is to produce a pound or a tonne of copper. Over time, those cost curves have gone up. So at a time when we need desperately new mines to be built, you've got boards sitting there saying, there's no way I'm going to build. The reasons I've just outlined, but also, I don't know what my operating inflationary environment is. I don't know what my capital cost inflationary environment is. The incentive price for copper, traditionally speaking, and those of you who've looked at the mining sector for a while will know that the traditional wisdom was about the top of the third quartile, was about the incentive price. The price, in other words, that you would incentivise new supply. That's today's cost curve on the right-hand side. Now, the top of that third quartile puts you at, let's call it $10,000 a tonne, $4.50 a pound. Now, that's more than where we're at today. But we've been over $4 a pound for the last few years, give or take on average. How many new mines have been talked about in that time? How many mines have been committed to? None. This is part of the reason why. So we've got capital markets who have said to the mining sector, we're not going to give you any money, and indeed we want some money back, please. What's going to happen though is that if the capital markets won't reflect value, the corporate sector will. So we're now just starting to see this very first inkling of M&A start to take place. So you've had Newcrest become the apple of the eye for Newmont. You've got BHP in the throes of swallowing Oz Minerals. You've got the prospects of Mineral Resources spin off their lithium business offshore. All of this is not actually adding to supply. It's right hand going to left hand. But the point being that the supply remains a challenge, and M&A will start to reflect the value that is obviously being reflected in the market. This is at a time when institutional ownership is at all-time lows, or it's certainly many multi-decade lows. On the left, the Yale endowment, you can see the red wedge, red component of that is at multi-decade lows. On the right, this is a survey from JP Morgan, who survey Australian institutional fund managers. You can see their net underweight, again, multi-year lows. We are a possible solution for you looking for resources exposure. We are a global investor in the resources sector. TGF is our listed investment company, and we invest across the spectrum, but with a very big focus on base and battery metals. As you can see, around about half or a little over half of our portfolio in, let's call them well-known names for some of you perhaps, Glencore Tech, Alcoa, Freeport, but also into the smaller end of the spectrum, K2 Fly, BlackRock, both portfolio companies for us, but we're also big investors in what areas of the sector we think will be big beneficiaries of this decarbonisation thematic, and that is components like nuclear energy, so Cameco Energy Fuels. Draw your eye to the right-hand side here. We run a very diversified portfolio that we can move around with relative ease. We're often told, thanks very much, but I've got exposure to Rio Tinto. What people don't appreciate is that Rio Tinto, BHP, are not the diversified companies they would have you believe. 2/3 of their EBITDA is iron ore, and that's very difficult for them to change. So if you want to be exposed to iron ore, go your hardest, own Rio and BHP. But if you want to get diversified exposure to a decarbonisation thematic, I would argue there's some better alternatives. So with that, we think there's massive tailwinds blowing firmly in our back for decarbonisation. The fundamentals, whilst I say 22 was a tough year, demand was what many people were concerned about. The reality is supply is where they should be focused. And with investor positioning so far underweight, there's a huge wave of cash still to come into the sector. With that, I'll pause for breath, open up for questions.